let's welcome on board Pankaj Pandey as well and figure out what he's making of the markets right now. Pankaj, hi, good morning. We were just debating whether this is the peak of the good news and whether markets have priced it in all at these levels.
So hi, good morning. See, overall census from an earnings perspective, 9 months we have done about 742 odd, growth of about 5-6 odd percent. Last 2 days back when I checked, I think Q4 numbers are largely on expected lines. So easily 1,000 kind of a EPS would be achieved. We've seen decent improvement on a quarter-on-quarter basis. Overall sense is that the domestic flows in core categories are intact from a mutual fund perspective and also from the FII perspective. I think a bigger sector like banking has seen a good amount of flows. And I think technology looks sort of bottomed out. We are no longer seeing selling there. While the global cues or the global macros are still sort of jittery because China is still attracting about 30% kind of a duty. But overall sense is that the worst is behind us. So we would want to believe that markets are headed higher in subsequent months.
Pankaj, why is that we've not seen too much of follow-up buying after that big Monday? I mean, the decks are now cleared for perhaps all the concerns in the market, all the clouds on the horizon, they have faded away. Yet the market is not showing a lot of follow-up buying. The pickup from Monday has not happened.
So, Nikunj, overall, when we sort of look at FI flow, say if I look at NSE 100 as a universe, while BFSI contributes about 34% in terms of weightage, what we have seen is that the outflow is only to the tune of about 9%. So initially, we have seen good amount of flows largely into banking. But for technology and other sector, our sense is that you really do not require that kind of inflows. And technology, while price-wise, it looks like it has bottomed out, but our sense is that somewhere down the line, we are still not sure whether FY26 is going to be a washout year. So from that perspective, incremental flows are sort of relatively lesser. But I think since FIs are no longer sort of negative, I take that as a bigger positive.
Right. Pankaj, what is it that you're making of the earnings which have come by? And I want to start off with Eicher Motors. RE volumes, of course, have accelerated. They're looking at achieving the highest volumes in FY26. They're saying that the volumes are going to see a further pickup. Do you think that this is going to be one of the key beneficiaries of this entire premiumization trend, which is going to, spill through to the two-wheeler segment as well? And the fact that this has not really been, performing with the likes of, say, a Bajaj Auto, etc., which have managed to actually, move much higher in terms of a stock price action than what Eicher has done.
So we would want to believe that Eicher will do relatively better. If I go by the recent quarter performance, volume growth has been pretty impressive at about 24%. And I think monthly numbers are also sort of okay. I think the challenge for Eicher has been margins have been sort of weakish on a quarter-on-quarter basis. But overall sense is that the kind of refreshes they have planned plus the CV business is expected to sort of do well. And they are already sort of doing well in that particular segment. And so from that perspective, I think overall the setup looks good for Eicher to sort of do well this year.
Okay. Pankaj, these drone stocks have now almost become ghar ghar ki kahani after what's happened with, where drones were used in terms of that, drones have become the new bullet now, let me put it this way. What are you telling your clients now? Because everybody, I'm sure, must be calling you or been wanting to know which is the defense stocks to buy, which has drone, or which is a drone company which can buy, which can fly high.
So, Nikunj, I really do not have a company which sort of caters on the drone side, but from a defense perspective, I think we are seeing structural shift. To give you some color, say FY13 to FY22, we have seen acceptance of necessity of nearly 8.5 lakh crore. And in the last 3 years, we have seen acceptance of necessity of over 9.5 lakh crores. And subsequently, our sense is that these will sort of get converted to orders. You look at most of your PSUs, be it HL, Bharat Electronics, VDL, Mazagon, the overall order backlog is somewhere about 6 times FY25 revenues. And on top of it, this is not the end of the orders. So, for example, if we are expecting about 65,000 crore worth of orders for HL, for Tejas, So from that perspective, I think defense is something which we feel that is a buy on dip opportunity. Any kind of a dip is a buy opportunity for defense. Structurally, this segment or this sector looks good to us.
Okay, that's the take coming in on what the entire defense pack is seeing right now. Also, Nikun just flagged off Jubilant Foodworks as well. City's come out with a note wherein they actually maintain a buy on Jubilant. They're saying that they've been delivering market share gain, growth as well as profitability for FY26. The management has guided for a 250 to 30 Domino as well as Popeye store additions in India. They're expecting to improve their EBITDA margin by at least 200 basis points over the next 3 years. Pankaj, as bullish the commentary may be from Jubilant, the street has been more, sort of hooked up with the QCOM platforms, the online retailers when it comes to food delivery as opposed to the QSR traditional spaces. Do you think it makes sense perhaps to have exposure to both in your portfolio?
So, see, from a consumption perspective, our sense is that the wallet share, which is increasing for, say, hotels, hospitals, or even from investment side, AMCs. Unlike what you see for FMCG and other categories. I think overall sense is that a lot of these trades are sort of crowded. And so our sense is that there are two, three categories which are structurally looking positive. So we are liking the entire hotel as a space. We've seen the overall sense is that the volume growth is expected to be about, or growth demand is expected to be about 6% supply is going to grow at 2%. And we have seen the ARRs inching up, and I think hospitals is sort of no different. And I think the other consumption category could be on the premium side, be it autos or be it a two-wheeler or four-wheeler. And I think in addition to that, within the BFSI or non-BFSI segments, for example, the AMCs look very attractive to us, whether it is a large cap performing or mid cap performing. I think these are the categories which we feel are expected to do a lot more better than a food delivery or because that looks more crowded to us.
Pankaj, do you think there is an investment opportunity when it comes to steel, specifically perhaps led by Tata Steel? We were just looking at the numbers and they look pretty okay. The visibility for both the UK as well as the Netherlands business as well, it seems like FY26 is going to be the year. India demand in any case was intact.
Oh, yes. I think when you look at steel as a sector, the context is that the prices are at a 4-year low, then you had imports at a 10-year high. And with 12% kind of a safeguard duty, our sense is that for a company like Tata Steel, which did somewhere about 12,000 rupees per ton kind of a EBITDA in the domestic side, with company guiding for a 3,000 kind of a overall price appreciation, I think the numbers are going to get better for Tata Steel. And even the UK business, the kind of cost reduction what they are taking, I think that will be visible in the next year. So from that perspective, Tata Steel is expected to sort of do very well. We like the entire steel as a pack. Even Hindalco's number, Novelis especially, the EBITDA per ton was better than our estimates. So I think cement and steel are the two sectors where we are constructively seeing a material improvement on a quarter-on-quarter basis. I think steel will see a better set of numbers in Q1. So I think the maximum opportunities are going to sort of lie there. I will not really say the same thing about SAIL because typically in a scenario when the prices goes up, the most inefficient player sees the highest price appreciation. So from that perspective, we would still want to sort of prefer Tata Steel or JSW Steel or Jindal Steel and Power.
But Pankaj, how are you viewing the entire paint segment, especially Asian Paints? You think the negatives are all priced in because this is the one which had that big shake-off and pretty much got downgraded across the board and derated, so to speak, when Birla Opus came into the market?
So on the paint side, when I look at say Asian Paints, the last 2 quarters, the volume growth has been about 2-3%, which is substantially lower than the long-term growth of low double digit to what we expect. While margin pressure is expected because Birla Opus is offering nearly 10% kind of a lower prices. And while the price damage in Asian Paints largely looks down because valuation-wise, it's trading somewhere about 44 times on a forward basis. But for us to sort of look at this stock or the entire paint segment constructively, I think the volume growth needs to pinch up. Till that time, it does not happen. I think that it is going to remain sideways. Or in case if the price intensity sort of goes up, I wouldn't rule out a minor correction as well from a price perspective.
All right, so that's about the paint sector. But Pankaj would like to thank you for taking the time out and speaking with us this morning. Thank you very much for this.
Thank you so much.
If you like this video, then like, share and subscribe to ET Now.